The word IFRS 2 share-based payment by itself suggests that the payment which is to be made based on shares. So IFRS 2 share-based payment, it includes both payment to be made based on shares to employees and also to the non-employees. Now let's compare it with existing Indian accounting standards. In India, there is not a single accounting standard which talks about share-based payment. But yes, we do have a guidance note. There is guidance note on accounting for employee share-based payment, which talks about accounting of ESOP and all kinds of payments to be made to employees based on shares. But when we refer to IFRS, there is a specific standard of share-based payment. Now, one of the very important difference with guidance note issued by ICAI and IFRS 2 is that this share-based payment of IFRS 2 includes both employees and non-employees. But guidance note which is issued by ICAI is only referring to employees share-based payment. So the scope of IFRS 2 is wide enough to cover all kind of transactions and not only the transactions which are relevant to the IFRS to the employees. Now, before we go and go forward and look at the slides, the word share-based payment signifies the fact that any payment which is based on the shares of the company are covered here. So share-based payment will include either a equity settled, cash settled, or alternative. Now when we refer to the next slide, we will talk about there are three kinds of transactions which are covered under IFRS 2. 1. Equity settled share-based payment. 2. Cash settled share-based payment. And 3. The alternative which is given to the either of the party. So first, equity settled. Now the word equity settled share-based payment itself suggests that the payment is based on share, but settlement happens by issue of equity shares of the company. So it's called equity settled share-based payment. When we refer to the cash settled share-based payment, it again says that the payment is based on shares, but settlement happens through by way of bank or cash. So there is a liability which is come into picture when we refer to the cash-based settlement plans. Now there is one survey which was done by EY with respect to the share-based payment, and that will signify the fact that how this particular thing is very relevant and important for all users. The survey was conducted just in 2014. It was a recent survey, and says that for Indian companies, when the survey was done, it says that 88% of the companies who are having a share-based payment, they go for ESOP. So one of the very important feature which is used by the Indian companies for share-based payment is ESOP. So when it refers to any of the companies which are having a share-based payment, generally it is either ESOP or SAR, the stock appreciation rights, which is one of kind of cash settled share-based payment. Another says that average vesting period as a survey by all the companies was around 3 years. And the industries, when you look at industries, which industries generally go for this kind of share-based payment, it is techno, media or telecom industries. So 37% of industries which generally issues share-based payment is techno, media or telecom industries. 71% of the companies are offering stock-based incentive plans. So all the companies which are being surveyed, 71% of companies are saying that they are already offering the share-based payment. Now this is what which is very important features of share-based payment right now. Now when we look at this particular standard, the standard was issued in February 2004. When this standard was issued in February 2004, the survey was done at that time, and it was said that if the S&P 500 companies has followed IFRS 2 share-based payment earlier before the issue of standard, then the net impact on P&L account of the companies will be lower by 19%. So this standard we suggest that you need to recognize expenditure of share-based payment. Now let's take case why there's a need of IFRS 2, because I always say that first, if you want to understand any standard, the most critical is that we have to be very clear about the objective of issue of the standard. Why there's a need of IFRS 2? Now if the employee has been issued ESOP and the ESOP plan says that the vesting period is 3 years, that means the employee is going to stay in the company for 3 years, then only the employee is eligible to get the ESOP. So now there is a cost which is involved when the employee has been offered ESOP shares at a lower than market price. Now when the employee is performing services, he is getting salary remuneration as per his employment terms, and also some part of compensation cost which is being borne by a company on issue of ESOP is also accrued over a vesting period. So when we refer to the standard IFRS 2, it says that the share-based payment need to be expensed off over a vesting period. So that calls of expense recognition over vesting period. Now let's go through the standard slides. Okay, this particular slide signifies the fact that I always say that it's like a carrot kind of thing, where the employees has been given some incentive, and this policy has been actually taken by so many companies because of the two reasons. One is that it is being treated as either motivational tool or it is being treated as a retention tool, because at least for the hope of getting ESOP being vested for 3 years, the companies would like to continue to stay with the company for a longer period. So this is a kind of incentive or motivation tool for companies. The objective is to specify the financial reporting by an entity when it undertakes a share-based payment transactions. A transaction in which the entity receives goods or services as consideration for equity instruments of the entity, or by incurring liabilities for amounts based on the price of the entity's shares or other equity instruments of the entity. Types of share-based payment. I already briefed you about. There are 3 types of share-based payment. One is equity settled, second is cash settled, and third is share-based payment transaction with cash alternative. Scope. First, group entities. Now first question is it applicable to the group companies? Yes, when we refer to IFRS 2, the scope says that yes, it is applicable to the group entities. Now what do you mean by group entities? For that we will refer to IFRS 10. IFRS 10 says that group includes parent and its subsidiary companies. So any shares which are issued by the holding company to the employees of the subsidiary company is covered under the scope of IFRS 2. Now second question is that is it applicable to associate or joint venture? As the definition of group which is defined under IFRS 10, it does not include associate or joint ventures, but there is not a specific standard which talks about this particular proviso. So we have to refer to IS 8 para 10, 11, 12 for applicability of this particular provision in case of any shares which are issued by a parent company for the employees of associate or joint venture. Business combination, IFRS 3. Now if the company has issued shares with respect to a purchase of any business, then it is excluded from the scope of IFRS 2, because there is an IFRS 3, a specific standard which talks about these provisions. So with respect to purchase considerations and fair value considerations of issue of shares to the acquiring company, you need to apply IFRS 3 with a combination. Now another question is that whether this particular standard will apply to only services or both goods and services. It applies to both goods and services, one. Second thing, it also includes the assets or any other items. So it doesn't mean only the goods which are in the ordinary course of business, but it includes all kinds of goods. Another question is that in case if the share-based payments are issued to employees, the capacity as holders of equity instruments. Now in such case, whether IFRS 2 is applicable? Now IFRS 2, the main objective is that when the payment is made to the employee specifically, now here the employees are shareholders and they got payment not because they are employees but because they are shareholders, and these particular equity instruments are issued to all the shareholders in the capacity of the shareholders, then IFRS 2 is not applicable. IFRS 2 is applicable only in case where the shares are issued to the employees as a capacity of employees, not in the capacity of shareholders. Fair value. There is a specific standard IFRS 13 fair value measurement that talks about the fair value, but for the purpose of this particular standard, IFRS 2 will override a fair value definitions, and we need to refer to IFRS 2 for arriving and measuring the particular goods or services or equity instruments at fair value. Now let's go to the first phase of this particular standard, that is equity settled share-based payment. Recognition. Recognition is a very straightforward recognition. You have to debit expenditure or asset and you have to credit equity, because what is there that it is like you received goods or services. So the expenditure is either goods or services, and you are going to issue the equity shares in the futures, so it is credited with equity, and the recognition or timing of recognition is over a vesting period. So whatever expenditure which you incurred, that need to be amortized over vesting period. Next slide is about measurement. As I said in the earlier I-37 that each and every standard will have recognition, measurement. Under measurement, the fair value of goods or services received with the fair value can be estimated reliably. Now it says that first thing is that if the employee is providing services to the company and for receipt of services to the company has issued share-based payment ESOP to the employees, then the standard says that it is possible that the company is not able to reliably measure the services which is rendered by the employees to the company, because it is very difficult that when the employees being received both remuneration and service payment, then what is the portion of the service which is consumed by the company with respect to only service payment, which is very difficult. So in that case, the standard allows you to measure fair value at the equity instrument issued. But in case of the goods or services which are received from any party other than employees, it is rebuttable presumptions which is taken by IFRS 2 that fair value of goods or service is reliably measurable, and in that case one need to apply the fair value of goods or services, and only when it is not reliably measurable, then only you have to go through the fair value of the equity instrument. Now let's compare this for time being with our guidance note which is issued by ICAI. Under ICAI guidance note, and also there is a CB guidelines which is issued on ESOP. The both gives the option of either fair value or intrinsic value for measurement of the share-based payment. ICAI guidance note definitely suggests and recommends that the fair value is preferable. It is recommended to use the fair value, but both options are given to the particular company. Under IFRS 2, the measurement is only fair value, and intrinsic value method can be used only in a specific restricted situations only. So fair value method is the only acceptable method under IFRS 2 except in a specific situations which are given by IFRS 2. Now this is what we discussed: measurement with employees, that is fair value of equity instruments, if it is others, that fair value of goods or services received. In rare cases, if the entity is unable to estimate reliably the fair value of the equity instruments, then measure equity instruments at intrinsic value. Now measurement date. Measurement date is the grant date. Grant date is a date on which the parties reach the shared understanding of the terms of arrangement. So the first thing is that if it is an equity settled share-based payment, then you do measure fair value as per the equity instrument as on grant date, and based on that you need to amortize your compensation cost over a vesting period. For transactions with other employees, because we say that if it is not employees, then there is a rebuttable presumption that the goods or services fair value is determinable. In that case, you do arrive at the fair value as on the date of goods or services received or rendered. When to recognize the transactions for employee services? If the equity instrument is granted vest immediately, then you do recognize immediately. But if it is vesting, if there is a vesting period, then over vesting period. And also you will look at the condition which are specified for the purpose of a vesting requirements. Now vesting conditions can be either service conditions or it can be performance conditions. Performance conditions can be market based or non-market based. These all things you have to consider for the purpose of estimation of number of awards which will vest over a period. There is a need to have modification in your stock option, either to revive the underwater options, or basically what happens is that, for example, the company has given to the employees that you can exercise the shares at ₹10 per share. When the exercise price was issued, when the particular ESOP scheme was issued to the employees, the market price of the share was 50 rupees and the exercise price was ₹10. So it was advantageous and beneficial for the employees to get the ESOP. Over a period, the company's share price has reduced from 50 rupees to 5 rupees. Now, the exercise price for the employees is 10 rupees, market price of the share is 5 rupees. Obviously, the employees are not going to exercise the ESOP option right, because they can purchase the shares at a lesser amount or at a lesser price from market. So just to revive the underwater option, generally the modification has been done, and in case of modification, if there is an increase in fair value options, that increase in the amount of compensation need to be amortized over a remaining vesting period. Cancellation or settlement. If there is a cancellation or settlement, it will give a rise to the immediate recognitions as if it is vested. Second is a cash settled share-based payment. Now, cash settled by nature says that the liability is created. In case of Part A, equity settled, equity is to be issued over a period after a vesting period on exercise by the employees. In case of cash settled share-based payment, it is settled by way of cash or bank. So the liability is created. So the most important difference between equity settled and cash settled is that under equity settled share-based payment, the remeasurement does not happen at every reporting date. The measurement which happens at the grant date is to be amortized over a period. In case of cash settled share-based payment, every reporting date it is to be remeasured. So remeasure at a fair value at each balance sheet date until the liability is settled. Difference on remeasurement is included in the profit and loss account for the period. Third is a share-based payment with cash out alternative. Now here the case is there where the alternative is given to either entity or a third party. So there can be two kinds of alternative. One, the choice of form of settlement is given to the counterparty, or it is given to entity. If it is given to entity, this company is going to decide in which they are going to settle these particular transactions. Then it can be either equity settled or cash settled based on the particular transaction. So if there is no commercial substance for equity, or if there is a present obligation to settle cash, then it is to be accounted as a cash settled share-based payment. Otherwise, it is to be accounted as a equity settled share-based payment. If the choice of form of settlement lies with the counterparty, in that case, it is a kind of compound financial instrument, which the option is given to the third party that they can select a form of settlement either in equity or debt. Then you need to divide the instrument into two portions. One is equity and second is a liability. Now we are coming to the last slide, that is share-based payment transactions among group entities. Now this is a general case with respect to so many MNCs and listed companies. What happened that the holding companies issue shares to the subsidiary companies' employees. Now the subsidiary company receives shares. Subsidiary company's employees receive shares of the holding company. The services which is rendered by the employees of the subsidiary companies are rendered to the subsidiary company, but the shares are issued by the holding company. In that case, how to settle these particular transactions? So first thing is that you need to determine whether this transaction is a equity settled or cash settled. It is a cash settled if there is an obligation on the subsidiary company to reimburse to the parent company for the cost which is borne by the parent company for issue of equity shares to the employees. So the accounting whether equity settled or cash settled is based on the obligation of a company for reimbursement of the cost to the parent company. Let's go to the slide. So there are these kind of situations. One, if it is settled by the own equity shares. I will try to include all kind of situations in this particular slide. If the subsidiary company is settling the obligation by issue of its own equity shares, it's very easy. We already discussed it is equity settled. Last part is that if it is to be settled by cash by the subsidiary company, it is again very simple. You have to use a cash settled share-based payment. But if it is settled by equity shares of parent company, then there are two options available. One, there is obligations on a subsidiary company to reimburse to the parent company for the cost which is borne by the parent company to issue equity shares. If there is an obligation to reimburse, then it is a cash settled. If there is no obligation to reimburse, then it is equity settled. And if it is cash settled by the entity or to the parent, then it is cash settled. So in summary, if it is an obligation on a subsidiary company to make payment in cash either to parent or to the employees, then it is cash settled. But if there is no obligations for a subsidiary company to make payment to the parent company, then it is kind of equity contribution by parent to the entity, and hence it is called equity settled share-based payment. I think this is basically end of our IFRS 2 share-based payment transactions, and basically what we have done in session 2 is that we discussed and gone through about IAS 37 provisions, contingent liability, contingent assets, and IFRS 2 share-based payment. Now I am just giving you a brief summary of a difference with Indian GAAP and IFRS. Under IAS 37's provisions, contingent liability, contingent assets, the standard is same with respect to IAS 29. The only difference is with respect to the discounting of provision. Under IAS 37, if the time value of money is material, the discounting is required, which is not a case in case of IAS 29 Indian accounting standards. Second thing is with respect to contingent assets. Under IAS 37, contingent asset need to be disclosed if it is a probable, which is not a requirement under IAS 29. Now let's move to IFRS 2 share-based payment. Under IFRS 2 share-based payment, again, when we refer to the difference, under Indian GAAP there is no standard, but guidance note on employee share-based payment is governing the accounting requirements, and it says that basically there are two options which are given to you. One option is that Either you account as per fair value method or intrinsic value method. Under IFRS 2 share-based payment, there is only one method which is recognized is fair value method. Only in rare cases you can use intrinsic value method. There is a specific requirement of group-based accounting under IFRS 2 share-based payment, and also when we refer to the scope of IFRS 2, the IFRS 2 scope is larger compared to guidance note because it includes all kind of transactions where the shares based payment is to be made, which includes even the non-employees, while the guidance note is applicable only in case of employee share based payment.